Today, I'm going to talk to you about life insurance and what would happen to your property if you were to die and you didn't have life insurance in place when there's a mortgage there. The reason I wanted to talk about this today was a client came to me asking a few questions on it, and it's clear that the understanding of how it's going to work it isn't there for everyone. So hopefully this video and this podcast episode today will share with you what would actually happen. Now, if you die, what happens without a will in place, what happens is all of your possessions goes into your estate, and then the government will distribute that how they see fit. If you were to die with a mortgage in a home that you own, the same thing would happen. So this mortgage and the home would go into your estate. So you would owe that money, or your estate would still need to pay that money back to clear off the property. Now, that's a burden that you could be leaving to your kids, to your husband, to your wife. If you don't have cover in place, what will happen is they'll inherit that house, but they'll also inherit the debt. If they're not in a position to pay that debt off, what they would need to do is sell the property. Now, if you think if you are buying a property for your family to live in and you were to die, what would you want to happen to them? How would you feel if that was to happen? So it's really important to consider life insurance. The reason that prompted this question is that understanding was a little bit different. Yesterday I was asked what would happen in the scenario where if you were to die with a mortgage, would the mortgage just be written off? It doesn't work like that. So what happens is, although you're the homeowner, although you're on the title deeds as the homeowner, that home will pass into your estate, as will the debt from the mortgage. Because what the mortgage lender will do, although they're not the owner of the property, they'll take what's known as a charge over the property. In Scotland, it's commonly known as first dibs, if you like. So what the bank or the lender's saying is, we've got first choice on that money. If you owe them money, they need their money back. So what they'll do is, if you don't have life insurance and you've got no way to pay that back to them, they can force the sale of the property. What would happen if that was to happen? If there's equity in the property, then the equity would remain in the estate. So if the house is worth 100,000, sells for 100,000, and you owe the bank 50, that remaining 50 would go into your estate, but you would lose the house. Life cover would protect that from happening. I'm not going to go into the intricacies of life cover and what you should do regarding trusts and wills. We'll talk about that another time, but I think it's really important for you to understand that if you do die and there's a mortgage there, that will not be wiped off. It'll be up to your kids, your family, whoever the house is going to get left to make sure that debt is getting repaid. But as always, I hope you find this useful. If you've got any questions on it, fire them in the comments and I'll come back to you.